Good afternoon, everyone. I hope I'm audible to all of you. Uh, in this month's webinar of market updates, I'm going to share with you a couple of informations, couple of data points of what exactly happening globally, what is happening in Indian economy, Indian equity market, what are the sectors that we think that is going to improve from here, and what are the different opportunities that lay ahead of us, and what we as an investor need to do currently at this moment. So I hope I'm audible to all of you, and you can view my presentations properly. In case anyone is not able to view my presentations and audible, you can drop by in a chat box before I start. I can check my audio and video settings. So since there is no informations there, I hope everything is audible right here. Okay. So we talk about global economy first. So what's happening globally as far as the COVID situations goes, as far as the economy goes. We have seen that in as far we are in May right now, and most of the European and US economy, as well as the normal lifestyle, is coming to a normalizations, which is evident from the economic activity which is happening there. I show you some data point we'll able to understand. To start with, we have seen that US Fed has printed a huge amount of dollar. Uh, in fact, in their entire history, they have not printed so much of dollar in the last 1.5 years. And what happened as a result is that we all know that US economy was going, US GDP was going at a rate of 1 or 2% earlier, but now they are projecting their GDP growth rate to be at 6 to 7% post-pandemic situations. Okay, there are a lot of activities which has happened in Europe, in US. So you can see the Fed balance sheet or percentage of US nominal GDP here. Because of this huge pumping up of the economy, pumping up of the dollar, they have given huge amount of money individually to each and every investors in US, and most of this money has gone towards the equity market, although they have not gone towards spending as such. And that's why we have seen that huge US market rally in last 1.5 years. And now probably with normalization of things happening, you will see all the kind of money which has been printed there, which will come back to consumptions, and you will see a lot will happening there. Just wait, we got a chat from someone. Kindly, Yogendra, kindly you can check with your internet access, with your sound systems. I hope my voice is audible to everyone. uh, in case I'm not able, someone says, Yogendra, can you just check with your sound system if it is audible, because no one else has given it to me that they're not able to hear me properly. Okay, so I move ahead. So US, we have already said that what the Fed has done right now. Now, what is happening in the in the global GDP is that US is leading the global GDP. We seen in the current as such the world GDP we are expecting at 5.8%, and US will be at 6.3%. As I mentioned earlier, US economy, US GDP was growing at the tune of 1 or 2% pre-corona stage, and now probably after first and second wave of corona, they are expecting their GDP to grow at a rate of 6.3% to 7%. Now, why this thing has happened? Because of the huge pumping of the money. As I mentioned in earlier slides, they have printed a lot of money. They have done a huge infra push in different sectors. If you see in transportations, you see infra, power, broadband, workforce, schools and building, water, R&D, affordable housing, manufacturing, and home care services. They pump in so much of money in each and every sector in the last 1.5 years, which has resulted in expected that their GDP will grow to a huge extent. Now, why I'm mentioning US is that because most of the FIS money which comes to India is basically been driven from the US, and that has an impact in the Indian economy as well. I am going to share with you what FI's activity is there in the Indian market. You will to understand, and then you will able to correlate why this data point is important. Okay, so moving ahead, this is another factors on a positive side. When we are saying that US GDP is growing, US economy is about to grow and booming. This thing, a lot of money has been printed. Similarly, global debt has also soared to a record high, which is quite obvious because the kind of stimulus packages which has different government has given in the last 1.5 years, this is bound to rise. The interesting point here is that despite so much of money printed out there, despite the global debt are going high, our inflation rate has not picked up to the extent what we all were expecting, and that is one of the reason why the equity market across the globe has not not been indifferent to whatever happening right now or in the past, and it has gone past in record high in all the time. I always mention in all of my webinar is that you only need to watch the inflation data. If you see the inflation data, you will able to understand where the equity market will go ahead from now on. If you see the US inflation data, which I'm going to show you in next slides, uh, just a minute. US inflation data trader. So if you see the US inflation data, which is a correlated to interest rate, they are expecting to go high, but it has not gone high much as of now. So if the inflation rate is not going to increase, you will not see a huge slump in the in a global economy. Even if you see the Indian inflation rate as well as the bank interest rate, it has not gone high too much. Why? Because in fact in the last month we have seen the wholesale and retail inflation going down a little bit because of the supply chain getting better in India. So yes, but there has been a worry across the globe that the inflation as well as the interest rate might go high. Whenever there will be an interest rate and inflation correlated to each other go high, you will see an impact in the equity market globally. But there has been a huge speculation about that. But as I go ahead, US Treasury Secretary Yellen says that rate may have to rise somewhat to keep the economy from overheating, but they are not expecting a huge interest rate hike. Just to bring to you example that US has a cutoff benchmark of 2% inflation rate, with they are currently at 1.4 to 5% level. Similarly, in India, we have a cutoff of inflation rate, interest rate of 2% to 6%. Okay, so if you are able, if we are able to manage the inflation between 2 to 6% level, I am talking about the RBI repo rate. You don't have to worry about that. So going back to my earlier slides, okay. Now, what has happened that household has saved a lot since the start of the pandemic. The data suggests that obviously, as I mentioned earlier, that there's a lot of money being printed in US, and they have given a lot of money to their citizenship, which has normally gone towards paper money, like in equity markets and debt markets, internally as well as the global market, and that resulted in the increase in savings. People have not gone and buy consumer durables and other items in US, and that is one of the reasons why the inflation has also not gone high in that thing. The most of the money which is government has given to them, they have invested in the market, and which is evident from the stock market across the globe also. Uh, Another data point which validates what I have said right now, if you see the bond versus equity inflow in the last 12 years, 2008 to 2021, you see this is the global bond rally, and then you see the huge amount of market money has gone to the global bond as well as in the global equity also. We have seen a huge amount of growth towards investing in Indian global equities, and as a result, we have seen a huge, and most of the, when we talk about the global equity, most of the equity this time has come towards India, and that is why we have seen the market moving around 50,000 level and Nifty at 15,000 level right now. There's a huge amount of FIR inflows which are coming up right now. This is an interesting data point. Like people says that because of the COVID situations, market has crashed in first. So if you see, this is a US. We have done a correlation between Standard and Poor versus the COVID situations. US daily new cases and market performances. So I don't know whether it's visible or not. This yellow mark is the US daily cases, and this is the Standard and Poor index. So if you can see, in as far as the COVID cases has increased and it has gone down itself, but US market has steadily grown over last 1 year. It has not been impacted by the COVID thing. The similar thing happened in UK as well. This is the UK data point, and this is also the COVID data point. COVID new cases, they have dropped in first wave, as you have seen earlier, but now it has already been little bit volatility, but it has grown consistently over a couple of months. So irrespective of whatever COVID has happened, the global market has not reacted uh, to that extent. It has crashed down. Okay, The reason I mentioned earlier, because there are a huge amount of pumping happen from different economies. They have done a huge amount of stimulus package to the different people, and most of the money has gone towards the market. Now, I mentioned one risk factor in the term of inflations, because we have a huge global debt. We also know that there's a huge amount of money supply there coming into the market, which is lead us to exposure of an interest rate hike, inflation hike. So, which has not happened as of now. US Fed is expecting that the inflation can go high, but they're not expecting a huge high. So, if the only risk factor which we lie is that if the interest rate and inflation go high, market can crash. And this is another point. This is the commodity movements. Now, if you see the commodity price movement, it has gone high 50%. In a 252 data rate of change, and it has not happened in last 50 years. So that is a little bit of global commodity price I'm talking about. If you have any one of you have invested in global commodities, last 1 year it has given a phenomenal return. If you go and check in Google about different commodities fund in last 1 year has given 120, even 200% return. Okay, that has because happen is that because of a little bit of supply chain issue, and that is the reason why the commodity price has gone high. But we are expecting this to get rational in days to come as more and more economy are opening up. Most of the countries apart from India are able to manage COVID situations better right now. So we are not expecting this to go high from here onwards. Okay. Now, this is CPI, this is a consumer price inflation. So this is important data point. Okay, so that's what I mean to say that high probability of US headline CPI remaining above 2.5%. So that is a probability that, as I mentioned earlier, that they're expecting to go high. You know, let's see. We have to wait for that, and if it happens, like U.S. inflation going high, then U.S. Fed might increase the interest rate. And if the US Fed increase the interest rate, you will see the FI pulling out money from the India and go and investing in the US market, because then it looks more attractive. So we have to wait for these numbers to come up, and but Fed has already said that they are not in a position right now to hike very high interest rate because they want to support the economy as such. So this is the only data point that is the worry factor. If you mean to say that what is the COVID situations in India and what is the market will behave, the only point I will want to mention is that US Fed increasing interest rate is the only risk factor which I find in a current market situations. It can go high, but it will not go high extraordinary, because if they hike huge, or if they do not manage to cut the inflation rate or inflation well, then you will find the US economy slumping. But they're not going to do that because they want their GDP growth rate to move past 6% level this financial year and next financial year. So this is the only data point that we want to watch about, and the only worry point, if you want to ask me, that where will the Indian economy or the global economy will head to. I already mentioned this. Now, if we see the projection of the global economy bearing that inflation point, that's the only risk factor which I mentioned. And if you see that 2021, 2022, and 2023, you see there's a huge amount of projection happening across the global GDP. Now, US GDP was growing at the rate of 1 or 2%, in 18, 19, 17 kind of thing, and they are expecting to rise about 4 to 5% level right now. And similarly, in across the globe, if you see the China data point, they are like 1.7%. Obviously, in 2020 was bad across the globe. In India, we have minus 24% kind of thing, and in first 3 quarter, in overall we are minus 9%. But it will going to improve in days to come in 2021. It is obvious because most of the market are normalizing now, and in 2022 or 2023, they're expecting it will be global economy will be in the range of 4 to 5% normal GDP across the globe. So world economy will be 4% approximately now on. So if you see the pre-corona period versus the post-corona period, in fact, we will have a bit higher GDP growth rate in across the globe, and that is why one of the reason why I'm mentioning is that you can see a market going high from here. I'm going to show you when we talk about the India specific points, you'll see a lot of data points why I'm saying that I'm expecting market to reach new high in the next financial year. I already mentioned that. Now, what are the global macro trends that are happening? That consumer confidence is a very important data point. This consumer confidence index rose 121.7 in April. IIP is at 8 months high. Jobless claim is as record low. Retail sales is rising. I mentioned last year that most of the people have invested in stocks. Now you're going to see that this year onwards, the retail sale, the consumer spending will going to increase. Housing rose by 19.4%. In China, that is in US, in China, the business confidence jumped to highest in March. Retail sales rose by 34%. China's industrial profit jumped by 92%. In UK, consumer confidence rose to minus 16 from minus 23. Japan business sentiment index rose to highest since May 2013. Okay, so if you see all the data point, like in this is an April, you will see every country across the globe are having a huge better data point, a positive data point in all parameters. This is quite evident from the 10-year GSEC, which is closed lower compared to March with inflation worries easing on regular supply. So that's the data point which I'm having. Apart from this 10-year GSEC and inflation worry, all the data points are looking very, very positive right now. So you see in the global market, and if I mention that couple of companies in the last 4 to 5 years, if I mention couple of companies like Amazon, Alphabet, Tesla, Twitter, Facebook, Baidu, these are the companies. If you see the stock prices, they are like 40 to 45% year-on-year growth over the period of time in last 5 years. And when I mention all these top 5, top 10 companies, they are going to be top 10 companies in the next 5 to 10 years also, because of huge research, because of capacity utilization, and because of their potential to do changes with time. I mentioned the Netflix also. If you see the Netflix share price, it has gone mammoth in last 4 to 5 years. So if you are looking to invest right now, I mentioned where the global economy will be going in 2022, 2023, and 2024. The GDP is going to high. In India itself, you can invest in global fund. There are a couple of options available to you right now. One is a blend fund. Blend fund are like the companies who are offering blend funds. They invest in India's blue chip companies as well as the global blue chip companies. You can have those kind of funds, have a test of both the blue chip company in both the worlds. Then you have the global emerging fund. This is like all the global small companies where you can able to expose your investment to invest from India itself. Then you have the index fund. Index fund, like there are a couple of index fund. You can invest in New York Stock Exchange and any exchange across the globe directly into the index. If you see the New York Stock Exchange, if you see the Standard & Poor, it has risen like S&P index and Dow Jones index has moved like 15 to 16% year-on-year growth from the last 10 years. Okay, so if you can invest in an index fund, and last but not the least, that if a lot of investor ask me that how can I invest in real estate? Okay, not in domestic but international. There is a very interesting concept which has come in internationally, that you can there are real estate funds have come up, okay, which is called REIT, real estate market in Asia Pacific through investment in SPAM Asia REIT subtrust fund. So you can actually invest in any real estate in probably in Europe, USA, Asia Pacific, or anywhere through real estate funds. What happened is that it is much liquidity, it is much transparent. So if you want to buy a property in Europe, like you will have a physical property out there, probably if you're buying property for an investment purpose there. So so you buy property, someone has to manage it, you give it for a rent, you get some amount of money, there are taxation, documentation, everything goes around. Instead of that, you can buy actually a real estate fund in Europe. The money will invest in any countries you choose to invest in, and whatever rental income that will have, you will have incorporated towards that funds. So it will give a much easier way of access to real estate in different countries across the globe. So if you're interested to know more about the real estate investment in Europe and other countries, you can get back to me in a chat box. I've given my link so we can have a discussion out there. Apart from that, I normally recommending right now to invest in either in global index fund or in global blend fund. Okay, so there is a good amount of scope available. There are good companies out there which you can invest and take exposure to. So moving on, we talk about the global economy. Now we will talk about the Indian economy. Okay. Now, what are the headlines in April? Now, monsoon likely to be normal at 98% of long average, which is a prediction. Average of summer crop rises by 21.58%. Indian export in April rise 197% with growth sectors. Indian manufacturing PMI improved slightly, reaches 55.5 in April. So those are the headlines in April, Indian economy. This is the data point which I want to mention, that Indian GST collection jumped to 1.4 trillion, highest ever monthly GST collection till recorded. So a lot of people are saying that because of the COVID situations, because of how I'm not going into how the government is managing the situation and likewise on that thing. I'm not talking about those terms. I'm talking about economy and financials here. But in April, we have the highest ever GST collections, which actually shows that there is a heightened amount of business activity happening across the India. And because of the COVID situation, because of the demonetization, because of increment of digital usage, a lot of companies are bound to use digitally, bound to use the digital platform, and that's why a lot of money is coming towards the government by way of taxations. There are no loopholes which are available right now. So that is a very interesting data point which clearly indicates that a lot of business activities are happening than the past. And this GST collection 1.4 trillion is much higher than in December 19. In December 19 and January, we have like 1.1 and now we have 1.4. In December, January 19, 2020, we don't have that corona during that time. And things were normal. You can remember that market was going well that time. But now we have a much higher GDP collection than that time. So moving ahead, e-way bill generation was up 11.9% Y-on-Y. E-way bill is another good indicator about the business activity which is happening. It actually tracks the movements. Then another good point is that tractor sale. So we normally understand that when you analyze the data of tractor sales, you can understand what's happening in the rural economy. So if the tractor sale rose by 37% year on year in March versus March 2019, you understand that rural economy is going absolutely crazy right now. This is a real data point which you get from the CLSS. And that's the important data point I want to say, that India displaces China to claim the pole position on emerging market league table. So if you see the all indexes, composite index score, which we have, the data has been we got from the Bloomberg itself. India is recorded highest number across all the emerging partners in the globe. Real GDP growth rate we have higher, like PMI, manufacturing, export growth, CPI, import cover, exchange rate movement, and stock market capitalization. So in all parameters, we are at much higher than all other emerging market, and we have surpassed China right now. So that is a very good indicator, like what we are going to achieve in next years to come. COVID. Now we talk about little bit about COVID and what's the thing is about, and because COVID has impacted our economy, which we can say emotionally, but if you see the data point, it has not impacted that much. It has impacted a lot of people's life. It has impacted a lot of people's work also. But when we see the financials, when we see the economic data point, as I showed earlier, in fact, the COVID situation has improved the worldwide economy, and they are expecting a better GDP growth in days to come. Now, if you see the data point, like in US, wave 1, wave 2, and wave 3, that is the data point which we have. Like in US versus the India plus all other economy, India wave 2 is much higher. The race to which we all know, and with the kind of population India has, like it's a huge. Uh, Infection is climbing faster in India than the major countries. North, and we all know this thing. India daily cases more than 4 times peak in 2020, and a couple of districts are having a high peak, but but they're coming down. Off late, in yesterday's data point, we have seen that the COVID infections are coming down. But the one point, as I speak, this is a normal data point, but when I speak with a lot of clients and a lot of people, that the testing has also gone down. So which probably the data point is might not show you the actual pictures. But as we talk about the vaccinations, this is normal again, the COVID spread and all those data points. Second wave high on economy. Uh, so Nomura Business Index registered the steepest fall in over a year to reach 25 percent point below the pre-pandemic normal. Um, so having said this thing, however, this time now the interesting data is that like in last year when we have the COVID one wave one in March, we have seen market crash down from 40,000 to 25,000 level, and this time, despite we have a four times higher wave, the market has not crashed down. In fact, it is hovering around 50,000 level. Now, why this thing has happened? I always say that market behave 6 months and 8 months ahead of time. Now, last year in February, when we have the COVID situations, we market suddenly crashed down to 25,000 from 40,000 level, because there was no economic act data point to validate that, because market reacts 6 to 8 months ahead of time, and they expected that market, because of this COVID situations, things will not be normalized and fall down. But right now, when we have a COVID wave 2, which is four times higher than that, market behave 6 to 8 months ahead of time, and they're expecting things to get normal from here onwards. What is happening that time is that we have an extended national lockdown, no vaccine awareness and treatment, no manufacturing activity, no broken logistics supply, limited work from home infra, business consumer confidence fall to the cliff, sharp earning declines. But this time, what has happened is a regional lockdown, vaccine, and there's a better awareness. Manufacturing sector is working, supply chain is continuity, work from home infra in place, consumer confidence better, gradually drop, expected to gradually pick up. It is, and earnings we are improving. So despite having a four times higher COVID situations, we are seeing the market behave in a completely opposite way to what we had behaved last year. Now, a couple of data point: budget allocation of healthcare increased, personal expenses have curbs, cost rationalization by companies. We This is the important, like cost rationalization of company. I will say that a lot of our companies have cut down their cost by way of working from home. They have reduced the employee cost itself, but because of this, a complete digitalization mode, they have able to increase their business, and or somehow they remain at the same level, but since they have reduced their cost because of operating expenses lowering, and that's why it has impacted in their profitability. So if you see most of the companies balance sheet which has been declared in the March till now, they are having a huge profit, because of cutting down on the cost and better capacity utilization. Okay. So government emergency credit line, vaccinations, we all know vaccinations is happening. I'm going to discuss a little bit about vaccination, a couple of slides from here, so you will able to understand why we are saying market is behaving 6 and 8 months ahead of time. So they're expecting market to get normal, very normal in next 5 to 6 months time from here. Macro indicator business activity index in India is 75.7 in April. Liquidity, we have surplus 4.8 billion in April. GST collection is highest ever. 8 core industries. When we talk about the eight, see if you see the graph here, the 8 core industries from the March, so right now it has actually YOY, it has increased over the years. Auto sector, we tractor sector little bit down in April, but it has gone high from the last year. Fast track collection, capex spending, IMD normal monsoon. We are expecting a normal monsoon of 98%. Summer crop showing up area by 16.4% YOY from 6.87 hectares. Uh, I already mentioned unemployment rate, which has slightly increased in the month of April 2021, and inflation, we are at a moderate level right now. It has March data point. So if I see the April, it has gone down a little bit because of better supply chain management. Credit growth has normally remained stagnant, it has been reduced. So that's our couple of data points, and we have the mixed economy on the rising COVID situations. I'm going to quickly move ahead in these slides. Unemployment, as I mentioned earlier, it has increased a little bit in the April data. As of May, I'm showing as of 30th April. Now, mitigating this COVID crisis, we have a ramp of infrastructure, regional lockdown, COVID appropriate, we have vaccinations. And this is the data point which I mean to say that by September, October, you will find most of the Indians will have the COVID vaccinations done. We have a couple of vaccine which has been approved by the government, like Serum, Cardila, Sputnik, Novavax, Biological, and all these data points show that what the government has been planning to do over in the last couple of time. So by September, October, you will able to see that 53% of the 56% of Indian populations by end of the year will be get vaccinated. So that's a data point which was government sources, as we have able to gather data point from there. So nearly 56 to 60% of total Indian population getting vaccinated by the end of the year. And imagine 1.4 billion population, 60% vaccinated, like 1780 crore population. That's a huge numbers. If you see, the American population is 34 crore, whereas Indian population is like 140 CR. So that's a huge amount of activities that the government has in place. Probably the little bit, because of the sudden spike in COVID, we have seen a huge amount of crisis in healthcare in 1 or 2 months now. But as from June onwards, you will see things will more rationalize, the vaccinations will be more available. And probably by the end of September, October, you will have 56 to 60% Indian population getting vaccinated. Probably, even if the third wave will come, it will not impact the much as like the second wave or the first wave has impacted. India forms a very small part of global economy. I always mention that if you are an investor, a lot of people invest in India, a lot of people invest globally also. So if you sorry, so if you are an investor, India accounts for 3.3% of the global GDP. So in your investment kitty, you should have a little bit of global exposure, because I have mentioned earlier is that how the global market is performing, and I have given you data point, I've given you sources, ways of how you can invest globally out there. So to be a part of global investment, you can invest with your INR in global economy, in global indexes, in the global top companies. And most of the top companies we normally use daily, like we use Microsoft, Amazon, Netflix, Facebook, Twitter, all these things we use daily activities. So be part of their growth story in days to come. I've already mentioned earlier, and the data point of all these companies, they're showing that they're going to increase, they're going to have ROI double digit from now on. Another reason why you need to diversify your investment globally is that in every year you see that some of the countries perform better. It's not India all the time. So if you see in 2009, 10, in 20, in 20 China, we have different year, you have a different winners. So if you park some amount of money outside, you can get a better of those markets. So that's an Indian economy. So we talk about now a little bit about Indian equity market. Okay, I will quickly go through. If you see the performance across market cap, this is the Nifty 50, this is the Nifty mid cap 100, this is the Nifty small cap 100. Obviously, this is a 10-year, 5-year, 3-year, 1-year, and 1-month return. I have showed the return here itself. So if you see the 1-year return across, it has been huge. Like it's obvious, because 25 to 50,000 market has gone 50% level, and it has gone. So market has gone 50% level. It is exactly showing in Nifty 50, which is the blue chip index. If you see the small cap, if you see the mid cap and small cap, is huge. But even if you see the 10-year data point, in Nifty you have 10% return, like annual 10% return you have gotten if you have invested only in Nifty index. If you have invested in Nifty mid cap, you're 11%, and Nifty small cap, it is an 8%. That is an important data point. Like if you have invested in Nifty small cap, it is 8%, and if you have invested in Nifty mid in large cap, which is 10% in 10-year annualized return. So what that means, that I always say that a large company, a big company, will always have an economic of scale advantage in a longer run. So if you are looking to invest in a small cap company, I will probably suggest is that invest there. When you have a profit positions, do book that profit and move out. And if you are investing in a large cap company, a good large cap company, stay invested for a longer duration of time. You're going to have a decent return. Probably small cap funds will give you a very high return in short period of time. But if you see the higher, if you see the longer duration funds, you will always gain better results in a blue chip or in a large cap companies. So if you see the sector performances in last 1 year, metal is outperform all other sectors itself. Now, if you see the pharma, now that's why I mentioned that pharma is a sector which has given a good return, but it is yet to give massive return. So you can always look for a little bit of exposure in the pharma sectors itself for the next 1.5 years. But it's a sectoral fund, it is sectoral investment. Sectoral investment should not be for a long period of time. You get the profit and you move out from the market. Okay, so pharma is another sector which we are looking into, and IT services. Like IT services, it has gone high and it will going to surpass all other sectors in days to come. uh, Moving ahead, as I mentioned, foreign money. So if you see the global market inflow, most of the market money, FII flow, like foreign institutional investment has come to India. Okay, so that's the thing which I mentioned. Like when I talk about the US data point, like US investment in the global economy, global equity has gone high, and most of the money has come towards India. EPS, I will just quickly move ahead. So, market, mostly for the investor point of view, will move from fear to hope. Increase in COVID infection deaths will lock down real activities. We know that there will be no national lockdown from here. Increase of infection and death will, there are a couple of other diseases, black fungus and white fungus are coming up, but I don't expect that COVID second wave peak is already past all of us and it's going to normalize from here. We are going to have a mass vaccination. Yes, the drive is little lesser, but you have to understand the kind of sheer size of Indian populations. Like America is 5 times less than what we population we have. We have 1.4 and they have only 0.34. Okay, so normals of economic activity, fiscal stimulus and monetary stimulus are all there. So market will move between hope and fear. So it will be volatile. But what I expected, I initially last year, I also mentioned that market will reach 50 to 50, 55,000 level in June, July, when the market was at 25,000 level. And right now, seeing all the data point, I'm expecting market to reach at 60,000 level in next year. But yes, this journey will be volatility because, this COVID infections and sometimes some kind of data point will come up, so it will derail the market. Only risk factor I mentioned earlier also is the US Fed increasing interest rate. Now, if that happen, that can be a risk factor and can halt market to reaching that level. So apart from that, as I mentioned, equity market, there is no surety, no guarantee. There are certain points that we need to mention out here. So I always recommend that market will be volatile. Take the advantage of the volatility by having a staggered investment from now on. But in 2022, I'm expecting market to reach 60,000 level from where we are right now. Correction happens in every market. This is normal. If you see the data from 1980 to 2021, we have seen the correction happening in 1 year. Every year there will be some corrections, and because of this correction, because of this volatility, you actually make a huge amount of money in equity market. Um, Valuation wise, neutral weight. Momentum wise, we are neutral weight. So as I mentioned earlier, that I am not recommending a huge amount of aggressive equity investment right now, but you can actually invest in equity in staggered way, in different sectors which look promising right now. To more about the stocks, to more about the fund, you can get back to me. I've given the link in the chat box. We can have a discussions basis on your risk appetite and the investment horizon that you may have. Market cap to GDP is 96 right now. Our average since inceptions is 76, and we are at 96 right now. It is still lesser if you consider the world market cap to GDP, which is at 128%. Sorry. Valuations are at higher end of the fair value. If you see Nifty PE 1 year forward is 20, Nifty PB is 1 year forward is 2.9. This is an interesting data point. I share this data every month. Like if you see, like if the P ratio is 41.3 right now, Nifty 500 I'm talking about, in December we have a profit of 2.09 lakh crores. Obviously, in the last 1 year, we have a lesser profit in different quarter I have mentioned. So if I take 2.09 lakh crore profit and make it a annualized figure, which we come to a profit of 8.39. Now, at 8.39, with a market cap of this, our P ratio will actually come down to 23.2. So if the profitability increase, your P ratio is bound to come down. So don't look at the current PE and invest, because the PE might looks higher. But if we, over the period of time, if you have higher profitability growth, which you have seen that we have a huge amount of collections, I already mentioned about the March quarter profitability and all. So if you have an increasing profit, or even if the profit remains same, you will see the P ratio coming down and the stocks will look attractive that time. So don't look at the current P only for the context of seeing P. Okay. So if you want to know more about this PE calculations and what are the companies which looks attractive right now, get back to me in the chat box, and in the link there I can discuss personally with you. Wait. So small and mid cap, we are overweight right now. Large cap, underweight, and neutral weighted equity. That's our recommendation. So we are not going to talk about any specific stocks out here. That we can discuss offline. Revisiting the past, like every event in the past, when we have a huge amount of market disappointment, like Bombay blast, Vajpayee government for nuclear test, Kargil war, communal right, and everything, you find the market boom up from the next 4 to 5 years. So if you see the 1993 to 2001, despite all this event happening, market has gone high. 2001 to 2009, we have market going high. 2009 to 2021, we have market going high. In between, there will be a number of events which has happened over the years. So last 50, 60 years, if you see the Indian stock market, like 1979 till now, like we have seen a huge amount of growth in the market despite there's been so much of happening across. And if you see the data, this data point, like from the 1990 to till date, Nifty has given 13.6% annual return despite so many events has happened. Like this is the COVID situation which has happened, this is the subprime crisis which has happened. It has given over the years 13.6%. And going back, like key variables in the impact economy, which this is signify growth, we are expecting in medium term is going to go high from here. Corporate earnings, it certainly will go high from here. With COVID-19 impact corporate India, there are likely to be sequential improvement in Indian economy unlocks. FII flow is going to high because India is the only market across the globe which looks more attractive, and because of the sheer size, populations, and lot of opportunities and activities which is done from the government side itself. Although you might see that there has been a lot of media reports about what things are happening, what are negative sides and all those informations. But if you see that actually the data point, like if you see the index performance, if you see the Indian macroeconomic data points, which are extremely well, even before in COVID-19 situations, we are much better off in all the data points. I already shared a couple of data points with you right now. DII flow, another important data point is DII flow. Now, a lot of people tell me that why the market is at 50,000 level, because nothing is happening, which is not there. I have shown you the GST collections. I have shown you a couple of data points which is happening. DII flow, there are 8,000 crore rupees of investment today every month happen via mutual fund SIP automatically. 15,000 to 16,000 crore of investment every month happen via insurance ULIP product every month right now. And you might be aware that in PPF, government has mandated 4 to 5% investment in the Indian stock market every of the total portfolio. So that comes around 25 to 30,000 crore. So 50,000 crore of money every month comes to the Indian equity market from the DII sector itself, which was not there 4 to 5 years back. So 50,000 crore, even if the market fall, market will able to hold that. Even if I keep pulling out the money, market will able to not go to that extreme level which we can think of. Okay. Supply of papers, well, credit supply paper will be a worry point, but higher disinvestment target and repair of leverage balance sheet to create supply in the market. In the days to come, we will see a lot of public sectors going, disinvestment strategy will happen in days to come. LIC IPO will also going to come in this, probably not this year, probably next year beginning will have listing policy reform initiative, expected improvement will happen. Equity market has become more volatile recently. This is normal. As I mentioned, the equity market will remain volatile till the time we reach 60,000 plus level. I already showed this data to you. Now I'm just going to show you a couple of sector so you can able to understand what sector is attractive right now. Automobiles current PE is 21, 10-year average is 16. So we are having a premium out here. Similarly with cement, I have already mentioned which sectors are getting at a premium or discount. Metals, which is still looks attractive right now. Utilities still look attractive right now. Pharma, 10-year average is 22, is 27. I'm expecting pharma to reach P at much higher level from here itself. So there is a scope out there in pharma also. Tech, well, it is already at a premium of 38%. So if you can see the metal sector, there is a scope. I expect pharma sector, there is a scope. Utility sector, I also have a scope, right? So this is a sector which you can look into while picking up the companies from the particular sector itself. If you see the PSU Bank, it is in discount. Like I don't know who, because I have already given a call about SBI Bank couple of months back, and you see the number share price of SBI Bank. So all the PSU Bank, I'm a little bit of bullish on the PSU Bank, a good PSU Bank, and because of the government measures on NPA provisioning and all these things, you will see you're going to see a huge impact in the PSU Bank, and you're already getting a discount of PSU Bank at minus 17%. Private banks, yes, it is a status quo right now. So, but there is still a scope in private bank gaining from here. Now, as far as we talk about the mutual fund, we talk about the sectors, we talk about the equity shares, which are the sectors which look attractive right now. Now, if you see the last 1 year performances, a normal equity hybrid fund, this is an investment where investment is being done on equity as well as in debt. It has given this much of return, 83%. And if you see the small cap funds, it has given return of 146%. I have shown you Nifty small cap has given 120%, and small cap fund on average it has given last year 146%. So this is a different sector in fund. We have equity fund, we have focused equity fund. This is a very focused, like couple of 20 to 30 stocks out there. We have flexi cap, which is a diversified fund. This is a 1 year return which I've shown here. We have the blue chip fund, emerging equity fund is a pioneer fund. So this is a different fund structure which we have. In this particular sector, we still expect the small cap to go high from here, as well as we are expecting this flexi cap to move from here. So if you're looking to invest right now, you can go ahead either in a small cap, in a staggered way, in a SIP way, or in a flexi cap way, you can invest. And apart from that, there's another sector which I have not mentioned out here, which is an asset allocation sector, which invest in equity, debts, and golds. The return of which is last 1 year is 15 to 20%, and it will remain like that. Probably not 15 20%, like 12 to 15% in days to come. So if you're looking to invest in a fixed deposit, you can look for investing in an asset allocation fund where your investment will be parked in gold, equity, as well as in debt in the proportion the fund manager fits its best. So if you see any asset allocation fund in last 10 years or 20 years performances, you will find the return in the range of 12 to 10 to 12%. Comparing it with FD at 5 to 6% right now, it is certainly much attractive. An asset allocation fund is more of, like, you will find since it is exposure to gold also, since it's exposure to FD also and equity also, it is much safer in the bet, like this thing. So where people say that they are looking for an FD investment, normally in fixed deposit you have 5 to 6% return in a year time. Where we're looking at an equity investment, in every day, like yesterday itself, we have seen a 0.6% or 1% movement in equity, a daily movement of 1% from here and there, whereas the annual movement of 5. You see where the money should be invested right now. So if you are a conservative or risk averse investor, I will recommend you to go with asset allocation fund right now. Fantastic fund. There are a lot of good products that are available out there. You can easily manage to get 10 to 12% post-tax return in that thing. To know more, get in the chat box, click on the link. I will get back to you and discuss personally with you. SIP, I already mentioned that it has been a phenomenal performances. If you see the SIP return in 1 year, this is only a blue chip fund I've mentioned. I have details SIP performances of all across the industry. In 1 year, it has given normally 40 to 50% return, and in 10 year, it has given return to the tune of 15 to 16% annualized return. Okay. So that are the SIP performances. Now the questions comes, we talk about the global economy, we talk about the investment opportunities globally, then we talk about Indian economy and Indian equity, we talk about the investment opportunity in Indian equity. Now the question rises that should we invest in gold? Like, this is a very interesting data point. Now what has happened in last week, if you are a little bit aware of what happened internationally, cryptocurrency prices has fall down from its record high. Like Bitcoin price was $60,000, it has approximately, it has moved down to $35,000 right now, because of China doing regulating a little bit of their banks, and because of US market giving an audit inquiry to the Binance, which is the US biggest crypto exchange in the world. So what happened is that because of that thing, the market has cracked down. Plus we have the Elon Musk stating a lot of Twitter about Dogecoin and couple of coins globally, so it has impacted that way. uh, but when we talk about, I will discuss a little bit about crypto in the next slides. But what happened in gold is that China opened its door to billions of dollars of gold import, and you're going to see a little bit of surge in gold price here. Only point will be like a risk of import duty. We have highlighted risk of import duty being reduced to our gold call. Same has played out in budget 2020, as import duty rationalized from 12.5% to 10%. If the import duty is reduced further, to the extent there will be a drop in gold prices. Okay. Otherwise, there is no risk in gold as such. Subject to the volatility, will remain bullish on gold on long term basis. Gold has corrected in recent time, providing giving you an accumulation opportunity. So you should always invest for a gold. Like if you have 100 rupees in your kitty, 10% of your total investment should be always towards gold. And I recommend investing gold via ETF mode, or a paper gold instead of having a physical gold. It is absolutely same as having a physical gold. You buy physical gold from any jewelry, you keep it in your vault at home or in a bank. You pay expenses whenever you go and sell. They charges do some charges. This thing, it is always a risk of maintaining at your place or your bank. There are some charges here and there. So instead, you can always buy a paper gold. The price is fixed to the international price. It is highly liquid. Any point of time you can redeem. It is highly transparent. So I will recommend you, if you're looking for a gold as an investment, you can try out gold ETF. It is as good as investing gold physically. In physical, you just need to keep that in your home or in bank vault, and you have to worry about its security, so charges and all. When you want to go and sell the product, what are the charges that jewelry will take and all. So instead, you go and invest in a gold ETF. In 2 to 3 days time, you can sell the gold ETF at international prices at with just a click away from your systems. So that the gold should not be more than 10% of your portfolio, and it's an evergreen product you can buy any point of time. So as I mentioned earlier, if you're investing in asset allocation, so you don't need to incur much investment in gold. So they already will taken care of your investment in gold itself. So Bitcoin, I mentioned earlier, there are a couple of events which has happened. It is a highly volatile currency. I normally avoid telling investors not to invest in Bitcoin, because Indian government is very very skeptical about that. RBI has time and again said that stay away from Bitcoin investment. They have not permitted our bank to do transactions with them. So you always have a risk of getting into the wrong hands of governments and the legal authority in India, and it is highly volatile. The next data point says that 95% of the global investors, like top 2.4% people, hold 95% of the cryptocurrency. So that itself says that it's highly speculative, and those people can manipulate it at their own advantage at any point of time. So stay away. I will not recommend you to invest in cryptos right away. Debt markets. So we talk about global equity, we talk about Indian equity, we talk about gold, we talk about cryptocurrency, we talk about now Indian debt markets. So Indian debt market, I've already mentioned, it is actually linked to the inflation number. RBI will have a huge liquidity right now. They are at a liquidity surplus right now. So rate will remain low in India. I mentioned earlier that inflation number of India is very, very under control. Till March, it was showing a little bit higher. In April, it has come down because of better inflow from better management of supply chain. CPI inflation is likely to remain in comfort zone. RBI has a comfort zone from 2 to 6% level. If the inflation data remain between 2 to 6% level, you don't have to worry about Indian debt markets. So a lot of people may think that government subsidies, corona, huge amount of investment by government in corona healthcare sector and everything. But if the CPI remain between 2 to 6%, leave about all the worries and don't to think about that thing. And currently, RBI has a huge surplus. In yesterday itself, RBI mentioned that they're going to give government 10,000 crore from the surplus to the government. So they are sitting on a huge supply and don't to worry about Indian debt markets and macroeconomic factors. Uh, so this is a normal. I don't going to read out this data point. And so normally what will happen in that the inflation number, we are going to remain range bound, so no worry about that. Rupee volatility also will range bound. Credit demand, government borrowing will go high. RBI policy will be accommodative. Global risk will be like normal thing. Corporate bond, FII flows in debt market will reduce. Liquidity will reduce in going days to come. So in debt market, we are not seeing a huge amount of worry as such. But since we are living in a global economy, the debt market worry remains, as I mentioned earlier, with Fed increasing the interest rate there in US, which we can't predict from here. So that's the only risk factor which I think lies right now. Uh, Moving ahead, this is the debt funds performances in last 1 year and 3 years. So in 3 years, if you can see, the dynamic bond has given 9%. Gilt fund is a government bond fund. Okay, so you invest in bank fixed deposit where you're getting 6 to 7%, and you see the gilt fund is giving 9% return. Banking and PSU, corporate bond fund, debt funds, short-term bond, credit, medium-term. So in debt funds, there are 16 different categories to invest. It is not as simple as fund like equity market. There are different funds. So if you are willing to invest in fixed instrument, only fixed deposit, which gives you 5 to 6% return. But if you see the government bonds are much safer than bank fixed deposit. Government bonds are giving return of 8.23%. Gilt is return of 9% return. So there are various duration government bonds, and each duration government bonds has its own purpose. So if you are looking to invest in fixed instrument, a slightly better return than bank fixed deposit, so you can get back to me. I have given my link in the chat box. You just fix up, you just inquire there. I will get back to you and we can discuss personally about that if you're looking for absolute fixed kind of return out there. Okay, so that's probably my end of sessions today. Thank you all for attending today. Be stay safe, stay healthy, and stay invested. Do not move out. I will only recommend that if any asset in any equities, if you're having a huge profit, then only book. Otherwise, do not move out just because you have recovered from the 25,000 level at 50,000 level. So we are going to reach 60,000 plus in next 1.5 years time. I have shown you enough data point to prove what I am saying right now. So stay invested. In case if you have any query, you get back to me in the chat box. Register whatever query you have in the link which I have given there. I can discuss personally with you in that thing. So having said that, so I finished my today's presentations. Thank you all for staying with me for last 1 year, 1 hour, and stay invested. And there will be a lot of opportunities coming ahead. I mentioned couple of funds, couple of stocks to you. If you want to discuss with me, you can personally WhatsApp me, or you can mention in the chat box and get back to you with that thing. Thank you.